Glencore is one of the world's largest and most influential commodity giants with a reach that stretches across continents and industries. Every day, Glencore shapes the materials and energy that power our daily lives, from the copper in our electronics to the fuel in our cars. Its decisions ripple across the globe, influencing everything from the price you pay at the pump to the livelihoods of workers in remote mining towns. Recently, Glencore made headlines by choosing to keep its main stock listing in London, a bold and surprising move at a time when many big companies are fleeing to New York in search of higher valuations and more investor attention. This decision comes at a tough time for the company. Glencore's profits are down, and its debt is up, putting pressure on its leadership and strategy. Investors are asking tough questions. Why double down on London when others are leaving for what seem like greener pastures? To answer that, we need to look at Glencore's unique business model, the challenges it faces today, and its ambitious vision for the future. In this video, we'll break down why Glencore's profits have fallen, why its debt has grown, and what's really behind the decision to stay in London. We'll also explore how this choice could impact not just Glencore, but the global push for a greener, more sustainable future as the world transitions to renewable energy. Glencore's story is about more than just business. It's about the global economy, the future of energy, and the tough, high-stakes choices that are shaping our world right now. When a company of this size and influence makes a move, the stakes are high for all of us, from investors to everyday consumers. Let's dive in and see what's at stake. Glencore's latest financial report paints a challenging picture with numbers that have caught the attention of analysts and shareholders alike. Profits have dropped sharply, and debt has climbed to levels that raise eyebrows across the financial world. This combination raises big questions about the company's health, its long-term strategy, and its ability to adapt in a rapidly changing market. So why stick with London now, when so many others are leaving for what they see as better opportunities? Understanding this decision means looking deeper at Glencore's vast operations, its global ambitions, and the risks it's willing to take. The answers reveal a high-stakes game with global consequences, where every move could reshape markets and industries. Let's unpack what's really at play behind Glencore's big London bet, and what it could mean for the future of commodities, energy, and the world economy. Welcome to Glencore's Big London Bet, a story of risk, reward, and the future of global business. Glencore's latest results paint a stark picture of a company feeling the squeeze from all sides. The mood among executives is tense, and the financial world is watching closely as the numbers come in. Core profits for the first half of 2025 have plummeted by 50%, falling sharply to $9.4 billion from last year's $18.9 billion. This dramatic drop signals a major shift in Glencore's fortunes and has sent shockwaves through the industry. The energy crisis boom that once fueled record profits is now firmly in the past, and the impact of this downturn is being felt across Glencore's global operations. Shareholder payouts have also taken a hit. Just $2.2 billion will be distributed this year, a significant reduction compared to previous years, leaving many investors disappointed and concerned about future returns. In response, Glencore is tightening its belt, holding on to cash reserves and cutting back on spending to better manage its rising debt burden. Net debt has surged to $13.1 billion, a staggering increase from just $75 million at the end of 2024. This rapid rise in debt is raising red flags among analysts and investors alike. More debt means higher interest payments, which eats into profits and leaves less money available for new projects, innovation, or rewarding shareholders. Some expansion plans are now on hold as the company reassesses its priorities. CEO Gary Nagle describes the current environment as challenging, pointing to lower commodity prices as the main culprit behind these weaker results. He emphasizes the need for resilience and strategic adaptation. The once booming commodity supercycle has cooled off, and Glencore now faces the tough task of proving it can survive and even thrive amid these tougher market conditions. The pressure is mounting to get back on track. Investors, analysts, and competitors are all watching Glencore's next moves with heightened scrutiny, eager to see how the company will respond. The company's ability to adapt, innovate, and make tough decisions will ultimately determine its future in this volatile industry. Glencore's next strategic moves are more critical than ever, as every decision could tip the balance between recovery and further decline. The question remains, can Glencore weather this financial storm and emerge stronger on the other side? The answer will not only shape Glencore's fate, but could also send ripples through the entire market, influencing the future of the mining sector as a whole. What's really behind Glencore's recent profit drop? The answer isn't just about numbers, it's about the shifting tides in global commodities. Two words sum it up: coal and copper. These two resources have been at the heart of Glencore's business, but now they're causing headaches. During the energy crisis, coal prices soared to unprecedented heights, fueling record profits for Glencore and making it a star performer in the sector. But those days are over. Prices have now crashed back to more typical levels, slashing Glencore's earnings and leaving investors concerned. The coal division's profits plummeted as the market cooled much faster than anyone expected, catching the company off guard. This is the risk of commodities. What goes up must eventually come down. Volatility is the name of the game. Meanwhile, copper brought its own set of problems, adding to Glencore's woes. Glencore's copper output fell by 4% due to unexpected operational setbacks at some of its most important mines, further squeezing profits. Even a small drop in production can mean huge lost revenue when you operate at Glencore's massive scale. Copper is absolutely vital for the green energy transition. Think electric vehicles, wind turbines, and solar panels. Demand is only set to grow. Lower production raises serious doubts about Glencore's ability to meet future demand, especially as the world races toward renewables. Fixing these issues is now a top priority for Glencore's leadership, who are under pressure to turn things around quickly. The company's fortunes can change fast in this volatile business, where every decision counts and the stakes are high. Glencore must adapt quickly and make bold moves to stay ahead of the competition and protect its future. The stakes are higher than ever, especially as the world shifts to green energy and the demand for copper intensifies. Coal's decline and copper's challenges are testing Glencore's resilience and ability to innovate in a changing world. The next chapter for Glencore depends on how it responds to these challenges and whether it can turn adversity into opportunity. While mining struggled, Glencore's trading division stepped up. Unlike rivals, Glencore runs a massive global trading arm, buying and selling commodities worldwide. In turbulent markets, this division thrives, earning $1.8 billion in adjusted profit, offsetting mining losses. This natural hedge stabilizes Glencore's earnings when commodity prices fall. The trading arm's steady cash flow is a lifeline, letting Glencore invest and manage debt even in downturns. This dual model, mining and trading, sets Glencore apart from pure miners like Rio Tinto and BHP. The trading division's success proves the value of this strategy. It's the engine room that keeps Glencore running, especially in stormy weather. Without it, the financial picture would look much worse. This resilience is why Glencore's leadership remains confident. The trading arm is a crucial buffer in tough times. It's a silver lining in a cloudy report. Glencore's debt surge is no accident. It's the result of big cash outflows. The company paid out hefty dividends and share buybacks, rewarding investors for last year's record profits. But these payouts hit just as cash flow weakened. A massive $3.2 billion tax bill added to the drain. Ongoing investments in mines and new projects also required upfront cash. Plus, Glencore is preparing to buy Teck Resources' steelmaking coal business for $6.9 billion. All these factors combine to push debt higher. Management says the debt is within target, but reducing it is now a top priority. The plan used cash from operations to pay it down. Managing debt is key to reassuring investors and maintaining financial strength. The next few months will be critical. Glencore must balance investment, payouts, and debt reduction to stay on course. With so many companies leaving London for New York, why did Glencore stay? The company reviewed its options, but found most investors preferred the London listing. Moving would be costly and disruptive with uncertain benefits. Glencore's roots are in Europe, and its global identity fits London's international market. The decision is a rare vote of confidence in the London Stock Exchange. At a time when London's status is under threat, Glencore's commitment stands out. For some global giants, London still offers stability and reach. Glencore's choice shows the New York exodus isn't inevitable. The company is betting that London remains the right home for its complex global business. It's a strategic move with big implications for the city. Investors' reaction to Glencore's results and London decision was mixed, but not panicked. Shares dipped modestly, No surprise after a 50% profit drop and higher debt. Lower dividends disappointed some, but the market had already braced for bad news. The share price held steady, signaling that investors expected tough times. Staying in London brought stability, avoiding the distraction of a transatlantic move. Investors now want to see debt reduced and copper production improved. The share price will remain sensitive to commodity swings. For now, Wall Street's verdict is cautious patience. Glencore has time to prove its strategy works. The next steps will be closely watched. The company's future and its value hang in the balance. Glencore's plan to navigate tough times is clear. Discipline now, green growth later. In the short term, it's cutting costs, running mines more efficiently, and being selective with new investments. The trading division remains a key source of steady cash flow. Careful capital allocation is the new rule, no more free spending. Long-term, Glencore is betting big on the green energy transition. As a top producer of copper, cobalt, nickel, and zinc, it's positioned for the low-carbon economy. Electric cars, batteries, and renewables all need these metals. Glencore expects soaring demand and profits as the world decarbonizes. The Teck coal deal provides cash flow to fund this green pivot. The company's future hinges on the global push for clean energy. If the bet pays off, Glencore could lead the next commodity supercycle. The strategy is bold, but the risks are real. The world's green ambitions are now central to Glencore's comeback. Glencore's decision to stay in London despite financial headwinds signals confidence in its long-term strategy. The company is betting on its diversified model and the stability of its London base, but the risks are high. Debt must be managed, copper output fixed, and coal's decline navigated. The opportunity? If Glencore's green metals bet succeeds, the rewards could be huge. As a leading supplier of critical materials, Glencore could shape the future of clean energy. Its choices affect jobs, markets, and the global energy transition. The company's performance matters to communities, investors, and the London market. Glencore's story is about more than profit. It's about the pace and success of the world's shift to sustainability. The stakes couldn't be higher. Whether Glencore wins or loses will echo far beyond its own balance sheet. The world is watching this high-stakes gamble unfold.